On your money. Let us walk through some of these numbers, folks, because I know we've been very myopic on Washington, D.C., as we should be, but do not lose sight of what is going on in Europe. Their problems, despite the Greek bailout, etc., are not over. Look at these moves today. The FTSE 100 in the UK down 1%. That was a nice day for the FTSE. The DAX in Germany down more than 2%. The CAC 40, 1.8%. And the Italian market down 2.5%. The reason is concerns not only over sovereign debt, but also over bank debt, higher interest rates, and constricted capital. Commerzbank, the second biggest bank in Germany, has lost, look at these returns, 45% this year. Unicredit down 27%. Banco Santander down 14%. BNP Paribas down 10%. These are not household names in the United States, but these are major banks in Europe, and they're having a very tough time. So let us bring in now Alpesh Pate. He's a principal at Prefinium Partners. I got all that out in the pick a peck of pickled peppers, Alpesh. Let's go now and do the European bank problems here. You seem to be not that concerned that this is going to impact our markets or the global markets that negatively. How come?
No, well, if you actually look at, say, some of the very big banks, the likes of HSBC, Standard Chartered, Barclays, whose results were out today, they're actually generating huge sums of returns. And all that's happened is, in the case of Barclays, they just missed over-optimistic expectations. That's all. So I'm not particularly worried at all.
Well, Alpesh, go into those numbers if we can then, because, look, I hear what you're saying, and I understand Italy's got long-dated maturities and their banks are fairly well capitalized on the Basel III standards. That said, we're looking at an environment where interest rates have gone up, net interest margins are going to come down. We're looking at these banks all holding each other's stuff, right? Some of it we know now to be bad stuff. What's the best-case scenario here?
Best case scenario is what they're doing in expanding into China and into countries like India. If you look at the retail banking sector in those countries, the corporate finance, the investment banking sector in those countries where the IPOs are happening, that's where the big fees are being earned, and the wealth management. You're absolutely right about some of the toxic stuff they're holding, because the credit ratings on some of these bonds, particularly sovereign bonds, is an abomination. Not only could those credit rating agencies not predict the credit crunch, but they're giving the US a AAA rating when America brings its own debt to its knees and to the country to its knees, and it's still got a AAA rating. So you're absolutely right about the toxicity of the stuff that these banks are holding. They need to get out of US Treasuries, that's for sure.
They need to get out of US Treasuries. That's a really good point. I'd really like to know what is going on with Belgium and France as well, and whether or not this is going to be a problem in terms of the sovereign debt holdings of a number of these European banks, because the pigs and their problems are so well documented, but there does seem to be a deterioration in Belgium and France as well.
You're right in terms of some of the deficit to GDP of some of the European countries, and not just in the pigs. And yes, you've got France and Belgium, but look, this is nowhere near the kind of extreme levels you have with what is essentially a microeconomy of Greece. So I think we're getting a little bit too worried. If you even look at Italy, the Italians have been running huge deficits, rather like the Americans, for decades, and they've managed to scrape by and scrape through, albeit the Italians haven't had the same problems.
Yeah, but there's a Keynesian end point, Alpesh. That's the point, is that you scrape by until you can't. Right? And this is, I mean, I hear your point about America maybe not deserving AAA, but it's not like mom and pop in Iowa are day trading Commerzbank down 50%. These are major institutions who obviously see structural issues with big European banks for some reason.
Nobody's force-feeding us to enter into some of the weaker banks, because when you look at the broader indices, you look at the multiples at which, say, the FTSE 100 is trading, only a multiple of 11, similar to the Dow. And on a pre-election year, 17 times in the last 17 times, the US on a pre-election year has risen on average about 12%. So actually, the broader equity market is where you go. You're not forced into consumer stocks. You're not forced into some of the weaker banks, and that's what you do. You go into the broader equity indices, and for that, I have no problems with the US index or the FTSE index.
Okay, Alpesh, thank you very much.